Today we're going to talk about options open interest, and this is going to be a very, very critical element of choosing the right options to trade. So let's say we're going to do a few hypotheticals here, and then we'll get to the options. So let's say, for example, that you look at a chart like this and you say, okay, I see a good pattern here I want to trade, and instead of buying or selling the stock, I want to trade the option on the stock. And one possible scenario you might see here is perhaps a triangle, lower highs, higher lows, and so symmetrical triangle. So let's go over to the options and take a look-see at what's going on over there. So now we've decided, okay, here's a stock we want to trade, and we want to buy, let's just, again, for the sake of argument, we're going to say we're going to buy a call. All right, make things simple, because the focus of this is not the option strategy, but it's whether you want to take an option on this at all. And so we look at some expiration dates here. We've got November, December, February, May. All right, so let's go in here and look, see. All righty, so here's your calls. And here's your strike prices. Right now, the stock is trading at 1782. So if we wanted to go to, say, 1750, again, here's what's the problem. Open interest, 0. Volume, 0. Now, what does that mean? So those are two very different things. They're related, but they're very different. So open interest, which is primarily what this video is about positions that have been taken, trades that have been taken on that option contract, in this case, the November 20th, 17.5 strikes, and how many are still being held. In other words, they haven't been closed out yet. Now, volume is actually the trades done that day, and it will reset the next day. So it's not a cumulative issue. So this is where you look at it and, let's give you a quick little example here. Both volume and open interest talk about the liquidity of that options contract. And that's really the key. We want to get good fills. We don't want a lot of slippage. We want to buy low. We want to get in at a good price. We want to be able to get out at a good price. The other thing you want to look at, so again, open interest, how many people are holding that position, volume, how many are trading it today, and then the bid-ask spread. Okay, so again, this is just horrible, right? This is horrible. So the bid is 0. The ask is $10. So let's see even where there is some activity right here. Well, one contract was traded. All right, and here, again, just in general, the bid is $3. The ask is $13. Huge spread between the bid and the ask. All right, so no bueno. We don't want that. No, because, I mean, again, there's just such little activity, and my rule of thumb is that whatever the bid is, I want the ask to be no more than 10% of the bid. So in this case, the bid is $3. Add 10 cents to that. I wouldn't want the ask to be any more than $3.30. And I'm not going to buy it for $3.30, but I want that tight of a spread, and that's still 10%, right? Which is nothing to sneeze at. And then I'm going to try to get something in between there. I might go ahead and put in an offer at, or a bid at say 310. See if I can get it. And sometimes I can. You know, the typical wisdom is you got to go about halfway in between. But I'll tell you, if you use a brokerage where you can get some really good fills, then sometimes you can get better than that. It depends. The liquidity, the interest, all of that stuff. Okay, so here's Lululemon, and as you can see, very, very, very different scenario here. So now, when we look at this, what do we got? Okay, so let's go to, as an example, we'll go to the 340 strike price. Okay, again, November 20th, 2020. All right, so now, first of all, let's look at the open interest, and hello there. That's what we like to say. Well over 100, 618 outstanding contracts. That means there's people out there to sell to you, right? They got it. They're holding it. They have open positions. Another thing that I like to see with open interest is not just that. I like to see a cluster of good open interest. So really, this whole thing, I mean, looking at all these different strike prices, Most of them are over 100. Some are really close, but that is also a great indication because as prices go up and down, we want to see that there's liquidity to buy and sell into as it changes. So you can't just think about the contract that you're buying or the contract you're selling or the combination of contracts if you're doing spreads and things like that, because as the price of the stock goes up and down, things go in and out of the money with options, and you want to see that, oh, you know what? No matter where this thing goes, there's going to be liquidity there. And that's the key to get good fills. This is all about being able to get in, get out with a good price. Okay, and because it's hard enough trading and just being right about the market. So my goodness, you don't want to be right and then not be able to make any money because there's nobody there to give you a good price when you get out, or a good price when you get in. So you cannot sacrifice this. This is black and white. This is not optionable or option. Little, dad joke there. But despite the bad pun, it's really not optionable. You got to, and I know the real word is optional, but I'm going to say optionable anyway because, well, I'm a card-carrying dad, and I've got a license for dumb dad jokes, and I'm not afraid to use it. Oh, and then let's not forget about the bid-ask spread. So the bid, we'll just round it up. So $12 bid, ask $12.70. So if we add, well, again, 10%. So we'd add, say, $1.95, $1.20, whatever you want to call it, to this. All right, and so it'd be $13.20. Well, we're below $13.20 in the ask. And so, again, that is the widest range that I'll allow. Now, you might say 10% is a wide spread, and it kind of is, but option prices can move dramatically because they're also determined by other multifaceted things, theta, delta, gamma, all sorts of things, beta, volatility certainly. And so there's going to be a lot of flux there. And also, I'm not going to pay the $12.70 here that they're asking for. So I'm going to get as good a deal in there as I can. I'm actually going to try to buy it for less than half of the spread, see if I get filled. And if I don't, then I might move it up to half the spread. If I don't get filled, then I might move it a little bit above that. Give it maybe 5 minutes to work. It just kind of depends on how it's operating intraday. So there you go. Super, super important. Don't get carried away just because you see a good setup on a stock chart. You've got to have liquidity in those options. Otherwise, you don't take the trade. At least that's what I do. I do not take the trade. That's a deal breaker. Done. Out. Next. I don't care how good the setup is. If you want to get my free options mini course, feel free to go over and get that at freeoptionscourse.com. Again, freeoptions, plural, course.com. 3 videos, shows you why I love options so much, gives you some inside tips, more advanced than this, as to why option trading gives you more advantages over things like trading stocks, futures, Forex, commodities, and how you can, well, potentially make more money if you become really good at this and proficient and professional. There's so many advantages of options. There's risks as well, just like everything, two-edged sword. So got to be very careful about that. Make sure you do not trade options until you understand them completely and you understand the risks completely. Research that in depth. So big advantages, big opportunities, but also potentially big risks, and you got to manage your risk and your money management more than anything else. So there you go, Barry Burns, Top Dog Trading, out.